Good morning and welcome to OETV. I'm Mehdi Sunderji and I'm joined by Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back.
Great to be here, Mehdi, as always.
As always, really, this has been quite the week since we last spoke. It's certainly been a tough one. You had indicated being in the camp of going to maximum cash last week and being very underweight equities as much as possible. And it seems that had you positioned yourself, this would be quite the testament to be living by. There's definitely some green in the futures as we speak. But you published your notes on Sunday night. Let's dive right in. There's lots to get through.
Yeah, I'm not too worried about the futures being up today. They were up yesterday as well. And, I think we're going to see a lot of volatility here. The market's very oversold. The S&P 500 reached a level of oversold that, in the past has coincided with counter trend rallies. And so in my opinion, that's really all this is likely to turn out to be here. A nice little 1% pop. I would use it to sell them all if you can. We believe the market is at the precipice of a major decline. And a lot of people might think that sounds strange since we're already down 23, 24%. Wasn't that already a major decline? We think this could be, akin to what we saw in 1987, not necessarily a one-day crash of 20%, but over the next 4 to 5 weeks, it would not surprise us to see the market down 20% from where we are today. With that, we continue to stick to our knitting, and that is recommending our clients maintain maximum cash reserves and minimum equity exposure on a net basis relative to their mandates.
So, Jeff, looking through your piece this week as well, you're also indicating a much more prolonged economic rollover.
We are, and we use this week as an opportunity to really just kind of reiterate and kind of summarize the points that we've been making for the last 6 months, really. Our clarion call since the first week of April has been to sell equities and raise cash at every opportunity. And we continue to believe that we are at the earliest stage of a possibly 2-decade economic downturn. And the reason that we think that is we looked at the most cyclical data that we could find going back 110 years, and that's the Dow Jones Transportation Average. And we detrended that price data and looked purely at its momentum over the last 110 years. And what we found is that there is a 34-year low to low cycle that is easily identifiable in that data set. And we just peaked right on schedule at the most recent 34-year high. And we believe that over the next 17 years, we will experience an economic deterioration that is not expected to bottom until about 2039, based on the last 110 years of data.
Well, that's not very much to look forward to. So, Jeff, also looking at the fact that we haven't had a formal announcement, which I guess is generally a backward-looking statement of being in a recession, you're saying that the data is actually highlighting that we are in a recession currently.
Well, if you take a look at the first half of the year, economic growth collapsed. And, we saw first quarter real GDP, final first quarter real GDP came in at negative 1.6%. Second quarter was actually revised up from negative 0.9% to negative 0.6% in its first revision. It may be revised up again, but when I look at third quarter real GDP growth so far, and this is based on the Atlanta Fed's GDP Now model, which has been a very, very accurate way to kind of look at GDP growth in real time. And we just saw over the last 3 weeks, the third quarter come in from 2.6%, which was where it was tracking, to now 0.3%. So, we're just on the precipice of cutting across that zero bound again. And if we do, it'll be the third consecutive quarter of contracting real economic output. It'll be very difficult for the NBER to look at this data in arrears and not say that the economy is in a recession. Maybe it's more of a rolling recession, but there's no question in my mind that growth has slowed dramatically. And, we're seeing it in housing. We're starting to see it in consumer. And, I think it's going to show up in the earnings in the not too distant future.
So let's have a look at inflation. Obviously, a lot of conversations around inflation at the moment. It feels like you believe also that inflation is peaking, but is this a bad thing?
Well, if inflation is peaking, I think we need to beware, because if we look back over the last 50 years, every time inflation has peaked, it has been coincident with an economic downturn of some magnitude. And if we look back at the largest, well, first of all, we can say that this spike that we've seen in inflation is the largest in absolute terms and the third largest in percentage terms, looking back over that period. And if we look back to the two that exceeded it was 1974 and 1981, right? And those recessions that followed the 74 and 81 inflation peaks were considered to be the most severe economic downturns prior to the Great Depression. And so, when we think about where we are today, if we're challenging those economic periods of 74 and 81 in terms of where we are in terms of inflation, it seems probable that the flip side of that will be an economic decline that is on par with those two.
So would you expect more tightening?
Well, there's no doubt that the Fed has signaled they're going to tighten more. The Fed is now targeting an additional 125 basis points of tightening this year. They've put out an expected midpoint terminal Fed funds target rate of 4 5/8. So between 4.5 and 4 3/4 is kind of the range that they're expecting based on the dot plot. Now, the street is in line with them. The street is now looking for slightly less, about 100 basis points of tightening this year. And the street's at a terminal Fed funds rate of around 4 1/4, a little less than where the Fed is indicating at this point. The real question is how, in what period of time is this going to take place, and in how big an increment is it going to take place? And right now, the November Fed Fund futures data, as far as the CME Group's FedWatch tool is concerned, is projecting about a 67% probability of a 75 basis point hike at the February 2nd meeting. So, I think that the Fed is going to err on the side of going big, right? It'll be the fourth 75 basis point hike in a consecutive hike. And, that will put the Fed at over 375 basis points of tightening inside of 9 months, basically. And so I think that this will be a historic sort of effect on the economy. And keep in mind that these rate hikes take a good 6 months to really work their way into the real economy. So we're not even seeing the effects of the last 375 basis point hikes yet.
More to come. So where do you see the 10-year Treasury yields going?
Well, we've broken out of a 40-year downtrend, and that should not be ignored. We've taken out a range consolidation that dates back to 2012. And, at this point, I doubt that the 10-year yield is going to just spike higher without some form of a retrenchment. Our sense is that as equities break, and that's our view, as we mentioned, money will flow toward treasuries as kind of a safe haven. And that could bring yields back down to around 3 1/4 from where they are now at around, roughly 385. Our sense, though, is that once we retest that 3 1/4 level, which was the 2018 high on the 10-year Treasury yield, we'll be set up for a move to 6%. The breakout from that range consolidation projects a measured move to slightly above 6%. And we think over the next, say, 18 to 24 months, we will get there.
So Jeff, what about commodities? Dr. Copper, our old friend, has been a long-term soothsayer of the market indication. Where do you see commodities going?
Yeah, to your point, Dr. Copper has been so good at predicting aggregate demand that investors have bestowed upon it an honorary PhD in economics. But Dr. Copper's down 31% and the spot price right now year to date. And so, or from its peak rather. And that in and of itself says that Dr. Copper doesn't think we're in a commodity super cycle. That's a question I've heard posited by many over the last 6 months. And I think it's starting to kind of fade a little bit here as commodity prices have rolled over hard down. What I think is happening is more likely we are having a dearth of liquidity affect all risk assets. And as liquidity leaves the field, price declines, and that's what we're seeing. So I doubt that we're in a new commodity super cycle. And in fact, I think the one asset that seems to be benefiting from this is cash.
So we were talking about it before we came on the air, the dollar. The dollar's had quite the move this year. How long is this, can it go this way?
Well, that's, an imponderable, right? Because a lot of things could continue to pressure the dollar up. We've been hearing, skeptics on the dollar ever since it broke out at the beginning of the year, questioning the sustainability of this. So far, we're up over 18% year to date, which is a record move in the dollar index. My suspicion is looking at this 50-year history of the DXY is basically that, we have broken out of a secular downtrend, and that suggests that we could now be in a secular or structural uptrend. And the breakout from the range consolidation counts to 121. So our first, kind of cut at where we're going is that, the dollar index could rally into the 120 area without too much trouble going forward. And we're seeing that the momentum, structural momentum measure at the bottom of the chart is indicative of that. It's seeing no resistance whatsoever. It's a straight shot up, supportive of price. And so, at this point, I think interest rates would have to equalize on a global basis. I think, right now, interest rate differentials favor US dollar-based assets, and that's where the funds are flowing at this point.
Now, all said and done, we've gone through the dollar, commodities, equities. Like, is this just a great buying opportunity?
We don't think so. We put this question mark here behind buying opportunity of a lifetime to really emphasize the fact that indeed, valuations, despite the fact that prices have come down, valuations remain at historic highs. Over the past, say, 90 years, we've seen stocks bottom at single-digit CAPE ratios. This is the cyclically adjusted PE ratio developed by Robert Shiller. And if we use cyclically adjusted data, and now we should, given the inflation rates, it's more important than ever to use cyclically adjusted data. But we saw historically mid to high single-digit CAPE ratios marked historic lows that were never again challenged, right? We saw that change in 1987, where the 87 crash bottomed at about 13.3 times. So, a low teens PE. We saw low teens PE again in 2009. During the COVID crash, stocks bottomed at 19.8 times. That was the highest bottom that we could recognize at this point. Now, if we look back at tops, the 1929 topped at 32 times. The 1999-2000 top was at 44 times, and that the January 2022 top was at 38 times. Today, we're at 29 times. So the question I would pose is, at 29 times, that multiple is much more representative of an epic market top, such as that we saw in 1929, than any previous generational low. Like that which we saw in 2009.
So it rolls us nicely into valuations. You've been calling for earnings revisions for the last several months quite aggressively, and it feels like the street's starting to wake up to some of this and lowering some of their earnings guidances. Is the street listening, and is it enough?
Well, I think that there's more to go. You know, we look at a measure called earnings breadth, and earnings breadth has turned negative recently, and that does not bode well for the future of earnings revisions. We've been in front of this. We've stress tested our S&P operating earnings model, really just kind of taking the current economic circumstances and plugging them in on a forward basis. And we have a very tough time coming up with 225, which is the street consensus estimate for 2022. We come up with $198. So we're about 14 percentage points below the street right now. That implies 5% year over year decline. Now, the street started the year looking for 10% year over year increase. They've cut numbers a tad. They're looking now for about 8% growth this year and 8% next year. We think next year will be another decline. We think at least another 3% decline. But I'm starting to hear more analysts, bearish analysts on the street, cut their numbers in the out year, looking for something more like a 5% decline next year. But still, conceding that earnings could grow this year, I think the cuts are going to be remarkably bold. We saw the first evidence of that with FedEx. And their CEO, Raj Subramanian, came out and suggested that, based on, their sort of perspective, it looks as though a severe global recession is on the horizon at this point. And, FedEx is really the tip of the spear for the economy. They see every nook and cranny with their, logistics business. And so I don't think that should be ignored. I think it's highly probable that we're in a recession, as I've said already, and that it will be a deep global recession, and that earnings revisions to the downside will be abrupt and dramatic. And so we could very well see, estimates come down 10% in line with what we're looking at. I think if we're wrong, we're probably still too high, certainly in the out year.
So, Jeff, let's have a look at the Fed. Can you connect the dots between the reduction of the Fed balance sheet and where this kind of likely guides us in the stock market?
Well, if we take a look at the correlation between the Fed's balance sheet and the stock market, really just looking back to 2020, it's been very, very highly correlated. 0.8, I believe, is the number that I saw recently. What I would suggest at this point is if the Federal Reserve follows through with their plan to reduce the balance sheet by 4.5% this year, that's over $400 billion. They're pulling about $95 billion out this month. And then another 13% reduction next year. That's about $1.1 trillion. As the balance sheet is reduced by that amount, I believe the stock market will follow it down. We've already seen the market react in advance to this year's 4.5% reduction. And if we just look at that sort of a relative change, applying that to the next $1 trillion coming out, we can easily see the stock market trade down to our published target of S&P 2250.
Well, you've been consistent on your 2250 level for several months now, so we are watching that very closely. What's this saying about investor sentiment? Investor sentiment over the last few weeks has definitely been, getting lower and lower. How do you see this happening, continuing?
Well, sometimes investor sentiment acts as a contrarian signal. In bull markets, especially. If we were in a structural bull market and we saw this sort of data, I would be saying this is a buy signal. But we're not in a structural bull market. In fact, we may very well be in a structural bear market. And if we are, this simply suggests that investors, both professional and retail, have recognized the facts for what they are. And the logical conclusion's uninspiring at this point. And so it's not surprising to us that we're seeing some sudden hedging action, put buying, and extreme survey responses, reductions in net equity exposure down to minimal levels on the professional side, and basically a bull bear spread of minus 40% on the individual side. This does coincide with bear market rallies. And so we're seeing something like that this morning, a 1% rally in the broad market. Not a big surprise considering where sentiment sits here, but this pessimism abounds. It's across the board, and that tends to see a response with people's portfolios. And so we would expect that the next follow-on from this will be that people's actions follow their attitudes.
Right. Speaking of actions, so we have this much, we have sentiment so low, how are investors actually positioned?
Yeah, so, this is a great study put out by Bank of America Research. And, they just looked at rolling 2-year returns and rolling 2-year fund flows, right? Positioning, right? And this is looking at households. Household assets allocated to equities through August are at a record high. Okay, they've never been higher than this in history yet. 2-year S&P returns are, plumbing, kind of the median, right? And so, we're breaking down some 24%. We're getting down to that zero level, and we think that the fact that households have not sold, given these returns, it leads us to believe that, and we have to conclude that 2-year rolling returns have not yet bottomed, and that a major liquidation of household holdings still lies ahead of us, because historically they have been closely correlated. In other words, as 2-year returns have rolled over, household holdings have been reduced in kind. So we're not seeing it this time.
Let's have a look at the market internals at this point. Things just seem to be getting even worse on that side as well.
Yeah, they are. Breadth measures are deeply oversold. There's no question about that. What's lacking here is any indication of a positive divergence. And what we would normally be looking for in a situation where we look at a lot of different breadth measures, but most importantly, the cumulative advanced decline lines for both the NYSE composite and the NASDAQ composite, which combined includes about 6,000 stocks. And what we're seeing is new lows on both of those measures. And in the case of the NYSE, which has made a new low, it's confirming price. In the case of the NASDAQ has not quite made a new low yet, but the advanced decline line has. And so it's actually jumping the gun there. My suspicion is that price in NASDAQ composite stocks will follow the AD line to the downside. Normally, what you would see is a new low in price and a higher low in the AD lines. And that would suggest that the market is setting up for a reversal. We are not seeing that. And in many indications, we're seeing dramatic new lows in some of the breadth data, which suggests to us that the selling is not over. In fact, what it suggests to us is that is the empirical evidence of institutional selling.
Some very scary looking charts there. So, all right, all said and done, are we in a cyclical bear market?
That remains the question, right? If we are in a cyclical bear market, then we should find good support in the 3,500 to 3,200 range. That seems to be where most technical observers have kind of, put their stake in the ground. If you look at this, classic pattern top formation, the head and shoulders variety, that counts to 3,500 on the S&P. We haven't quite gotten there yet. The problem is we got down to that 36 low in June, rallied back up into the 200-day moving average, and we've now come down and made a new closing low as of yesterday's close. Well, if we just measure that segment of this decline and really kind of extend it across, we're now looking at an inverted cup and handle formation of a much larger degree. And so proportionately, we have a minimum of 500 handles in the S&P to the downside. That should carry us down to the 618% retracement of this advance off the March 2020 low. And that gets us to about 3,200 on the S&P. The problem is there's really no reason the market has to stop there, because if this really is an inverted cup and handle top, we need to count from the peak in January, 48.18, down to 36.36. And from that level, we can count another 1,200 points to the downside, which then gets us down into the mid 2000s area, which is kind of where we've been discussing a downside target for primary wave 3 down in our Elliott wave work.
So if not a cyclical bear market, could this be a secular bear market?
That's exactly the question we've been asking. And if it's true, we've got to think about this from a completely different perspective. We've got to think about what degree of trend we're correcting. And so, we're looking here at a chart of the S&P 500 that goes back over 100 years. And, we're really trying to count the move off the 1932 low as well as we can. And we've counted it in the best terms that we can arrive at as super cycle wave 3. It is a 5-wave advance that is subdivided in 5 waves, primary degree and cycle degree. And so, we've got 3 very obvious degrees of trend here. The peak in January of 2022 counts best as super cycle wave 3. And if super cycle wave 3 has topped, then we are now in the midst of super cycle wave 4, which should be a corrective waveform that corrects a 90-year advance off the 1932 low. We are not going to do that with a 24% decline in 9 months. It could take years to fully correct this, and the wave structure could be incredibly complex. We put a very simplistic illustration here, an ABC, which would be the simplest sort of zigzag correction. My suspicion is it's not going to be that simple, but we need to focus on the wave that's at hand. And the first wave in this is wave A down. It should be a motive wave. And so if we're focused on that motive wave, we need to think about where that can bottom first. But in the grand scheme of this, if we are going to correct this entire super cycle advance, we could retrace up to a Fibonacci 78.6% of that wave 3 advance before it completely terminates. And that could get us back down to this rising trend channel base off the 32, 37 lows. And if we got back down to that level, it could be somewhere in the, sub 1,000 S&P level. That's to be determined, but it is hypothetically possible. So that's what we're focused on is in terms of the risk, we need to understand what degree of trend we're correcting here.
That is probably the scariest chart I've seen in a very long time. Let's hope it doesn't get that far. So where are we going?
Yeah, like I said, we're focused on wave A. And so if we look at this, we titled this chart, The Anatomy of Epic Reversal. We're at the very precipice of the beginning of this, if the chart and the prior chart's correct. And we don't know for certain at this point, but our working hypothesis is that we are correcting supercycle wave 3 with supercycle wave 4. And if that's the case, we're focused on this initial ABC decline, which will initially correct cycle wave 5. And so we've illustrated cycle wave 5 on the left. That's the 13-year advance off the 2009 low. And so far, we've put in a primary wave 1 decline, a primary wave 2 counter trend advance, and we are now in the very early innings of primary wave 3 down. Third waves are something to behold. They are really very powerful, very dramatic, and very surprising in terms of the magnitude of change. And I think it will surprise investors if this comes to fruition. A breakdown below the June lows should instill more selling pressure and fear, if not panic, in the market. And in our view, as we've illustrated in the chart on the right-hand side, we are about to break the 200-week exponential moving average, and a breakdown below that on a weekly closing basis, I think would confirm that primary wave 3 down is in progress, and that this is really a third of a third wave decline, which could be extraordinarily powerful and could carry the S&P to at least 2,700, probably before year end. And we've put out a couple of dates that we think make sense from a cycle perspective. These are, major cycle turn dates based on the work of Paul McCray Montgomery, and the first of which comes into play on October 25th. The second of which comes into play on November 8th, which happens to be election day. And in the middle, there's another Fed meeting, an FOMC meeting on November 2nd. And so the window between October 25th and November 8th is a critical window where we think we could be setting up for an interim bottom, meaning that it'll be the next big reprieve from selling pressure, whereby we could see some form of a lateral consolidation or a counter trend advance of some significance, giving those who have still failed to sell one last chance to sell before the final plunge into our wave A target of 2250, probably in the first quarter of 2023.
So, Jeff, you're generally known for your data and market analysis on the chart side of things, but it seems that even you can't stay away from some of the geopolitical overlays that we're seeing at the moment. How do you see this all feeding into your thoughts on the market?
Well, we're asked all the time, what's the catalyst for this? We don't know. I mean, nobody knows. These are sort of black swan imponderable events. But, just looking at the geopolitical environment, the risks are definitely rising. I mean, you've got a situation right now where, you've got three of the world's superpowers are, kind of staring each other down. Russia and China. I would say it's plausible that Russia and China are working together to undermine the West, and in particular the US, in order to achieve their own independent foreign policy objectives. And I would suggest that, based on what I've been reading, and some of my information comes, from Kyle Bass, who's been a major China hawk. But you can't discount it. It's all taken right from news articles effectively, and looking at a real-time sort of a series of events. And it seems likely at this point that China agreed to Russia's invasion of the Ukraine in order to kind of observe what NATO's reaction would be. And now that they've seen what NATO's reaction has been, they have been taking the steps in order to insulate themselves from any sort of adverse repercussions should the same reaction befall them. And why would that be the case? Well, we believe that China is preparing for some sort of a planned military move on Taiwan. They've been hoarding up to 2 years' supply of grain. They've been building their strategic petroleum reserves. And we think all of this is potentially in advance of, some planned military move on Taiwan, which would then give them control of the world's semiconductor chip supply. That is the center of the chessboard. And China knows it, the US knows it, and we've already seen the US making some overtures toward what we would do in response, trying to head it off at the pass. Biden has been overtly vocal about the US standing up and militarily defending Taiwan should it come to that. Nancy Pelosi, decided that she was going to make an unexpected trip to Taiwan and meet with leaders there, all flying in the face of a lot of criticism from China. And, not surprising if China really does want to make a move on Taiwan. They've clearly said that they're patient. They've clearly said that they're willing to allow things to take place over time diplomatically, but eventually they expect Taiwan to be folded back into China. And we saw what happened in Hong Kong, and China decided that they were going to jump the gun there. So there is precedent for this. And if in fact we see China take action, that could be the catalyst that sends the markets roiling.
So that's a lot of doom and gloom across every front. How do we position ourselves in this market?
I think preservation of capital is the key now. Our friends at Top Down Charts published this valuation matrix, if you will, looking at U.S. asset classes over history going back 40 years. And we're really looking at property, treasuries, the S&P 500, and commodities. And if we take a look at each one, the red line is property, and property is trading over 3 standard deviations above its long-term historical valuation mean. And based on that, it is the most expensive asset class on the planet. Equities are north of 1 standard deviation above their long-term historical valuation mean, and that puts them in second place. Commodities are trading about in line with their long-term historic valuation mean. And treasuries are now trading cheap to their long-term historical valuation mean. That does not mean that treasuries can't get cheaper, but in our view, it does look like the place to be within these 4 major asset classes. And our view is really that shorter duration treasuries and cash might be the best place to be. But for those who are really looking for some sort of a combination of liquidity, safety, income, and capital appreciation potential, we think a barbell strategy might actually work here, where you put about half of your capital on the short end and half on the long end, expecting that at some point long-term treasuries are going to rally because stocks are crashing. And that might create a capital appreciation opportunity. In the meantime, safety, liquidity, and income comes from a 4% T-bill. And so over the next 1 to 3 years, it's conceivable that a strategy of this nature could pan out much better than the historical 60-40 portfolio.
So before we get to top picks on the equity side, are there any sectors that you feel are worth mentioning?
Well, 2 that I'd mention. Number 1, staples was the best performer last week. That's not a surprise. Energy was the worst. And it looks like at this point, energy saw a discharge and is being discharged. At this point, portfolio managers are not, following the logic behind this undersupplied energy market, and they continue to believe that at this point, economic recession is in the cards at some point. They may not agree that we're in a recession today, but they're coming to the conclusion that it is on the horizon and it is a certainty at some point. And energy will be one of those sectors that does very, very poorly under those circumstances. We're still not completely convinced of that, and we haven't kicked it out entirely. But at this point, one has to question the logic of being long energy when it's leading to the downside. We continue to prefer areas like staples and utilities and healthcare. These are defensive sectors that should outperform in a bear market. They won't necessarily produce positive absolute returns, but they should produce positive alpha.
So trade ideas. Let's make some money in this market. And you have a long for us this week. So long and short.
I do. Yeah, so in line with that, staples, we've actually chosen Cal-Maine Foods, symbol CALM, CALM. Cal-Maine Foods posted a new all-time record high last week and broke out of a 6-month inverted, or I should say 6-month cup and handle base formation, shorter duration base, but a deep base. And so the breakout actually above 59 counts to about 76. The stock went out around $60 last night. So it's a nice upside potential here. We're using a stop loss at 55, which sets up a 4-to-1 positive risk skew versus that stop. And we think that Cal-Maine Foods has decent relative strength and is improving, and looks like it is bucking the trend of a bear market right now. So we would focus on stocks that are leading, and Cal-Maine Foods is a leader.
And what about on the short side?
On the short side, we want to stick with some of the bellwethers that really haven't seen as much downside as we think that is potential. Microsoft stands out, in our view, as having incredible downside based on its price and pattern. At this point, Microsoft has broken its long-term uptrend. It is now broken below chart support and sets up an inverted cup and handle top that dates back 18 months. This is a large degree pattern that, if resolved favorably to the downside, Microsoft has the potential to trade as low as 150. The stock went out at 238 last night. This breakdown below 250 counts to 150 ultimately. If the stock rallies back above 260, we'd back off the trade at least temporarily. But at this point, we think the stock looks like it could be in trouble, at least until earnings are reported on October 25th.
So you heard it here. Let's get long and calm. I think we could all do with that advice. Jeff, I want to thank you as always for sharing your thoughts from Alpha Insights. It's certainly eye-opening, and we'll be watching some of these levels as they pan out.
My pleasure.
And everyone at Open Exchange, thank you for making this magic happen live as always. And for our viewers, thank you for watching and good luck investing.